Hey everybody, this is Paul doing a quick late Friday video here. Market is currently closed. Um, just going to go over my portfolio for October since it is the end of the month and I want to get a monthly video up. Just going over everything that I did over the month. Um, so as it currently stands, I filled in some numbers here. Currently up $4,364 for the month. Asset difference is from there is up 6.71%. And then my dividends saw a massive increase. I'll tell you how I pulled this off. So as you can see, highest dividend amount I've ever had, highest amount of money saved I've ever had. So what exactly happened? Okay, so going into October, so we have to rewind to this area right here when the market became coming out of the summer. You had Delta variant going on, and like going into the summer, it's just like basically going into the summer, like midway through the summer, everything just kind of started to drop as you started to get more inflation news than you got good news. I guess is one way to put it. This is kind of like how we were getting more bad news last year than we were getting vaccine news. It's kind of very similar. So every time we got something that said inflation wasn't so bad, it kind of went up. When every time we got something that said inflation was bad again, it kind of went down. And then once the employment numbers started to reflect that inflation number right here in this August area, so you can kind of see it right here just in my gains. So like I, just going in, boom, boom, and then kind of had a little bit of weakness here, had that pullback, came back, had a really good month, and then all of a sudden, 2 months pretty much in a row where it was like, okay, well, maybe we're kind of going into a bear market, something's going on. And all the news was like inflation is going to crash the economy. So, like, what's going on? Well, during this period of time, even when the market was going down, I kept investing. And the simple reason is it's pretty obvious that the current inflation that we have right now is demand driven. So, it's not like wages are just going up and bills are also going up, and then also there's no demand for certain different things. Right now, every single company has been telling you we have more demand than we can possibly fill. Even employees are saying, hey, the people that quit didn't come back, so we have more hours to work than are actually even available to work in a week. You would need one person to work like 3 jobs. So you're having a staffing shortage. You have companies effectively being forced to raise wages. You're kind of seeing it at Walmart for sure. Costco is the most recent one. Starbucks was a very recent one today. And so it's pretty obvious that any report or anything that confirmed that would be received by the market very, very well. But when you don't have any of those kind of reports, it's a lot easier for the bears, like the people that think the market's always going to go down, that kind of thing. They think the market should be worth half the amount it is right now. It's very easy for those people to get on a news network and say something, and you can't prove them wrong because they do have the information, and the information for them was the jobs report that were coming in very weak. So you're getting these weak jobs reports, and during this entire period of time, like if you actually went outside, you could see like different things that were still just selling out on shelves. Like Coke was selling out, like Pepsi was selling out. You see stadiums full of people because vaccines work, and you're seeing Delta kind of go up, and then you're starting to see Delta go down a lot. So it was pretty obvious. It was either you're going to get good news on Delta or you were going to get earnings reports, and this is what changed in the month of October. So going all the way into there, this entire time I've been adding my portfolio out of my paychecks and stuff like that, and any of my winners, like the utilities, like that kind of stuff, I kind of sold those and then redistributed that money and then bought back into the utilities when they dipped. But pretty much October 1st, right around when we started getting the third quarter earnings reports, I mean, as soon as you got the bank reports that said, "What are you guys talking about? Our our stuff is through the roof. We've never seen this much money before, kind of thing. This is just massive amounts of money that we're getting. So as soon as the bank said that, Goldman, JP Morgan, they all said, we deal with these consumers on a daily basis. It's pretty obvious that the consumer is extremely healthy and they have a lot of money that they're starting to spend, especially if Delta goes away. From that point on, I mean, the market was effectively, it might as well have just been a straight line up. So if you bought in, pretty much from here, you added money into the market from here all the way to over here on October 1st, then pretty much anything that you bought into, a lot of the things that you bought into, outside of like some meme stocks or something like that, went a lot by a lot. Like going into October, you can see right there, 12.54%, and now I'm at 15.86%. And if I just had more, maybe like Tesla in there, because this is all really Tesla, but if I had like Tesla in there, that kind of stuff, be up a lot even more. But so if you go out to the 2 year, you can kind of see. So if I got to the 2 year, I'm actually tracking better with the S&P. But it's like the S&P is kind of playing catch up to where everybody else was, where everybody else was in 2020. It's kind of weird how that works, but so that's just kind of how it's going so far. But yeah, it's just that's the best explanation I got for October, as far as I can tell. It's just demand-driven inflation. Um, uh, you know, it's you kind of saw oil going up. A lot of the stuff is getting priced in. You have the Build Back Better program coming in from the Democrats. A lot of things in there. The monthly checks, the child care tax credit that might be extended for a whole nother year. So that's another major thing. So how did I mostly take advantage of this? So what I did is I added Kimberly Clark. So I got out of my position in Walmart, for example. So I got out of positions in pretty much anything that would take a big hit from inflation. So Walmart's kind of their thing is cheap food prices. That's kind of their big thing, is they're always be able to be cost competitive. Well, the problem is if inflation goes up, it's kind of harder. It's possible for them to pass it on, but they did wage increases, plus you know, they can't really pass on the food price increases like they would like to. They can, but they're not going to. Also, their dividend's really low. So what I did is I pulled all of my money out of Walmart, for example, took a $200 profit on that, I believe, and um, just basically redistributed that money. So I pulled some money, like maybe 2 shares out of like General Dynamics, for example, because material costs are going up. So manufacturing is going to get hit. So I pulled some money out of like little different things that I thought might get hit. Like I sold 1 share of McDonald's, for example. What did I do with most of that money? Most of it went into this right here, and I'm treating this right here effectively as like a high yield savings account inside of my account. So this is one that just pays out a monthly dividend. It just tracks high dividend aristocrats inside of the high dividend, low volatility names inside of the market. Ex dividend date's right there. Day it pays out right there. So I'm treating this effectively like a high yield savings account. So what's going on basically is I had like say maybe $3,000, $4,000 sitting in here, waiting for something to drop, and I finally got that something just 2 days ago when MO reported their earnings. I've been holding off on getting MO for a while because they're a cigarette company. That's kind of what they do. They cigarettes and beer. They're called a sin stock. The problem was I thought it was overvalued, and if you look at it, it's got a 29 PE, so it's trading at 29 times its earnings. And the problem I saw with MO is I saw kind of this kind of stuff. So like it was in the $51 range, and then it likes to drop. It was in the $50 range, and then it drops again, and then it does this, and then it drops again. So every time they kind of report earnings, they kind of do these little drops here, or they get caught up in themselves. What I was waiting for is for it to drop to a price where I'd be like, I'll add it back in. And I did the exact same thing with AT&T. I wrote it from 27 to 32, as soon as they said they might cut their dividend, I sold it completely. And I said I wouldn't buy back into it at 20 until it was at 25. Well, similar thing with MO. MO pulled all the way back to the prices that it was trading at in 2014. Right about there, give or take. Right in this little range right here. Closed at 45, so closed right there. Right in this little area right here, September 1st. And it has like a monster dividend. So they have a ton of earnings that come in. Like they do have a lot of profits that come in. Like they do have earnings. Like they're not missing their earnings. They missed their earnings right here. But they do have revenue. 5.5 billion, 5.6 billion. Their cash flows right here, 1 billion, 1.64 billion. This is money that gets distributed to the shareholders. So they have a monster dividend, just a monster dividend right there. This is just crazy high. And they pull back to a price that they haven't been at since 2014. So if you go further out, you're not going to get much better than the price it's at right now. It's just simple. So if you can get over the fact that they're a cigarette company. Now, what also I'm waiting for them to do is to realize that they can make a lot of money off of marijuana, like weed stocks and that kind of stuff. And I have a feeling that once they realize, oh, we can do something there, maybe Biden does something, they might finally jump into that market. They've got like a Canadian company that they own or partner with, but I think with these types of earnings and what the market's kind of expecting from them, I have a feeling they're going to shift into like the weed marijuana business here pretty soon, pretty big. Um, so we'll see how that goes. But right now it's just super cheap, and they have a monster dividend with a lot of with it's still just a monster profits. So I threw a very large amount of that. Also, one thing I noticed is one thing I've been waiting to pull back that hasn't pulled back for a while was Starbucks. And I jumped into this today, actually. This was down over 7, 8% today or something like that. I got into it at 105.72. I think it went down to 104. I was kind of holding off on this. I got into Starbucks at 96 and rode it all the way up to 111. I mean, it's Starbucks. Even though they have a low dividend right now, it's Starbucks. Like, no matter what Starbucks I go to around my house, there's a line going out the door. So, there's people that keep getting Starbucks. So, I think the China problem that they have, that they can solve that pretty easily. Because the China problem they're having right now is China has big breakouts of like Delta. Plus, they're having like really bad power issues. So, they just have a China problem right now, from what I can tell. And then I think they can just deal with this. So I got in at this price, especially if it dropped like say. That's effectively what this fund is right here. This is like a glorified savings account. So what I did is I basically sold a few shares to buy more shares in VTRS, more shares in, or the MO position that I took, which is very sizable. If you look at the MO position right here, it pays out in January, so he didn't want to pay it out in January, but he pays out $63 per dividend pay period. That's over $240 a year. That's easy. Like very, very easy money. Starbucks is just something that I think is going to be a dividend grower over time. I think they're going to solve the China problems. It's pretty obvious they are. So I can see holding on to this for quite a while. What happened before is the price of the stock got way ahead of their dividend, and their dividend was like very, very low. So I was like, yeah, I'm just gonna make a massive profit on selling Starbucks, and I did. So I did a very similar thing with Regions too. I got into Regions at 19. It was at 24. I think I made a $400 profit on that alone. That's where some of this money came from too. One of the things that I did add into was VTRS. This is the spin-off company from Pfizer. They do tons and tons of generics. And I think as the focus shifts from, as the focus shifts after we get past this Build Back Better thing, and maybe they start shifting more towards like people talking about healthcare, that kind of thing, because that's kind of important to people still, obviously. VTRS, Viatris here, has something very, very important that they have. It is a generic for Lantus, which is a diabetic insulin. Um, they became, and I used to work for Express Scripts, so I kind of get to, I don't know how much has changed since they merged with Aetna or Humana, whoever they merged with. But basically, it's a generic insulin. This is a very, very major issue right now, and it's been a major issue forever. So basically, it's a generic for insulin, biosimilar, and it's also on Express Scripts preferred pharmacy, and they do mail order for probably it's right here it says 28 million. I wouldn't be shocked if pretty much every other pharmacy under the sun starts buying this right here from them, insulin. That's pretty big. That's a major, major, major thing. Um, so that's very, very, very major. I expect, um, because basically right now they're just insanely cheap. They do generics. It's pharmacy exposure. I mean, their revenue is headed in a pretty obvious direction. I think more than likely they're going to beat this number, but even if they, like, this is analyst estimates right now, that there's no growth whatsoever, which is insane considering what they just picked up from. Yeah, I have a feeling that they're going to become, this is going to be kind of a big one. So I got a pretty big position in there anyways. So it's a stupid cheap stock. I am down by like 12% on it since I got it, but whatever. It's 3.3 dividend yield, and yeah, I own 155 shares of it. So every time that this pays out, right here, pays out at $17, it buys me 1.2 shares, 1.3 shares, and I might actually make this position bigger because I just have a feeling that this company is just going to grow. Um, this is like a combination of basically that spinoff from Pfizer and Mylan. So I was like, I all they need is if they beat their earnings, I have a feeling they're just going to jump by a lot. But this is like they have like a lot of debt and that kind of stuff that they need to get through first. So this is one of my longer term holdings where some of the money went. But it's a super cheap stock. It's easy to buy, very low price right now. And I think it's going to be around for a while because I mean they have generic medications, and I have a feeling that once they get past all the stuff in Washington, they're going to start talking about Medicare drug prices again. And that's when you get into generics. And this is the generic provider in the United States. So that's pretty good. What do I think is going to happen for November? Um, Depends on the job report. And then also, the Fed's going to taper, which means they're going to slow down buying bonds. And if you can't tell, the bond market is already priced in a Fed price. The Fed funds rate right now, I believe, is 0 to 0.25 for the 2 year. This is 25 basis points above that, and the Fed hasn't said a damn thing. The Fed could drop this down by a lot by tomorrow. Um, so, and then also you have the Build Back Better program coming in at a much lower price from 3.75 trillion to 1.75 trillion, and a lot of it's paid for with taxes on different things like, Apple buying back 40 billion worth of their shares. 1% of that is a lot. 1% of that will get taxed and go to the government. So that's something interesting. But yeah, you just kind of look at that. So I think when the Fed announces that, the market might be kind of like, I don't know, iffy here, there, all over the place. It's going to be a little weird for a second there. But we'll have to see how that goes. And then also one other thing I'm adding to also is AbbVie. E-Trade updated. So their dividend yield on a company like this is now 5.14%, which is just ridiculous. That is almost to the point of me wanting to pull money out of something. I don't know. I think if the government starts taxing buybacks, that you're going to see a lot more companies start to increase these dividends, especially if you see the Fed start to back off on tapering, which means interest rates go up. So these dividend yields that are kind of low, like Johnson and Johnson, maybe we might see something big out of them. General Dynamics, we might see something big out of them. Um, there's one or two that are sitting on here that we could see something big. Starbucks, I expect probably their next earnings report, we're going to see more dividends out of them. I'm thinking that you're going to start to see the dividend yields start to get closer into the threes and fours. And then Abbey is just ridiculous. Um, yeah, I can't understate. Like, that's a major player in the market with an enormous dividend right now. Like, they're no small company. This is a major company, like major pharmaceutical company with a monster dividend yield. I mean, $14 billion in revenue every single quarter, and growing and expected to grow. Like, their free cash flow is pretty beastly too. And, they're just like, they're smoking their earnings. So, yeah, it's a big one. So they're a very big company. I can see them getting a lot bigger, but that could be a big one that I'm looking forward to. I hope to add way more into that position, especially with that monster 5% dividend yield. Because that's just major. At some point I might pull something out of here, or maybe, or I don't know, I might pull the rest out of here, drop it into Avi come Monday, to be honest with you. But that's just, that's a pretty major one, so that's pretty good. And then also I want to add into my regions position, especially if interest rates are going up. That means the local banks and just pretty much bank stocks period are going to do really good. So um, hoping that the November jobs report, or actually the October jobs report that reports in November, right here on the 5th. If it's a blowout, we're going to see the market break even higher, because the taper is pretty much being priced in right now, and we got earnings that shows everything's good. So we would either need some ridiculously high inflation thing to go on, or the Build Back Better program to completely fail in Congress. Like, you need something really big to hit this market and knock it down a lot. And I just don't see it right now. Yields are still not inverted. 2 years still lower than 10 years, so there's no red flags there. Um, the 3 month is inverted with the 2 year. 3 month is yielding higher than a 2 year, which is, oh no, that's actually, sorry, I'm very wrong on that. 0.06, 0.5. So nothing's inverted here. The only thing I could see falling is maybe Tesla. Hope it falls, because that's kind of just an insane price. That's getting very ahead of itself. But that's Tesla. Um, there's really not a lot. Consumer spending would need to just drop off the map. To like consumer spending would just need to drop very hard to justify a big market fall, which would kind of indicate we're going into a bear market, because that's inflation, and then you're going to get the bears. But corporate earnings would have to reflect that. Like, corporate earnings would have to reflect that this is falling. So we're gonna have to watch it in November. I think maybe it trades flat for November, because you had just a ridiculous. Um, I have a feeling that November trades closer to what we saw right here. So this is that monster. This is when they sent out the stimulus checks right here. I had this monster month for April, or for March, just this monster month, and then the very next month it was still up 3.5%. You had one of these, and then it kind of slowed down. So I'm probably expecting something like this. But going into year end, like, something really has to go bad. Like, the government has to shut down in December, kind of stuff. We have to default on the debt or something crazy to knock this market down. There's just too much support. So, but there's a few risk factors out there. You're going to hear the bears talk about it because they want the market to go down, because that's where their positions are. But I just don't see it right now. So we're just going to have to see where it goes. So leave a comment. Let me know what you think, and y'all have a very nice day.